You know that thing where you get an amazing pair of shoes at a really great price and want to tell everyone about it? Yeah, so do we. Here at Designer Shoe Warehouse, we'll give you something to brag about, like the latest styles from brands you love, or the trends everyone's obsessing over, or shoes that make you feel like, well, you. So go ahead, show off a little. Find shoes that get you at prices that get your budget. Head to your DSW store or DSW.com today. DSW, let us surprise you.
Look at him, eating whatever he wants, never gaining a pound. While I'm stuck with the boring special and can't lose an ounce.
How's your lunch, man?
Amazing. Yours?
So good.
Oh, I'm so happy for you.
Cool, buddy.
Weight loss isn't fair, but Mochi Health is. The affordable GLP-1 source that can fix your frustration with food.
So, same time next week?
No!
Definitely.
And your friends. Learn more at joinmochi.com. Mochi members have access to licensed physicians and nutritionists. Results may vary.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. This week on the podcast, we have a lot of inflation data to go over. I also want to talk to you about historical patterns during war times. I know we have a lot of new investors here, and I want to make sure that we are having these types of conversations. I understand that when it comes to our portfolio specifically, there can be a lot of emotions of fear that trickle through during times like these. Let's take a look at the stock market's performance last week. The Dow was down 1.96%. The S&P 500 was down 1.57%, and the NASDAQ was down 1.24%. For the S&P 500, this is the third consecutive losing week. The week, of course, ending March 12th. The last time we had a losing streak like this was in March of 2025, so a year ago. The catalyst for the losing streak in March of 2025 was Trump's announcement of massive tariffs. I say massive, I'm not being hyperbolic. The amount or percentage that he announced an increase for tariffs definitely shocked the world. We were entering a trade war. In addition to the concerns that we had over a trade war, we were also concerned on how these tariffs were going to impact inflation. I want us to zoom out a little bit and see where we land from our all-time high on all three indexes. It's always really important for us to put everything into perspective and see how things are really performing. I can talk about a 3-week consecutive losing streak and compare it to what was going on a year ago. That instills fear. But let's go ahead and zoom out and see what we are really talking about in terms of the impact to the market. The Dow Jones from its all-time high is negative 7.11%. The S&P from its all-time high is down 4.96%, and the NASDAQ from its all-time high is down 7.73%. As a reminder, we measure the market by the S&P 500. That is the most cleanest way to measure it, and it is the closest measure we have to the economy overall. It only being down approximately 5% lets us know that the market is actually sustaining all of the news that is currently taking place very well. Now, of course, we can expect for war to impact the stock market in various ways. Overall, I think we can definitely expect a down market, but there is the defense sector that, of course, is going to overperform during this period. Let's go ahead and take a look to see how the stock market performed during World War I and World War II. I picked a moment in time that the stock market would have potentially been impacted the most to see what the historical pattern or movement was like. As we say in the stock market, history doesn't repeat itself, but it definitely does rhyme. So World War I took place during 1914 to 1918, and the stock market dropped about 30% in the first few months. As a reminder, a drop of 20% or more is a crash. And so the stock market definitely did crash, dropping at approximately 30 points in the first few months. And then the New York Stock Exchange did something that it has never done in history. This was the first and only time that it did this. They closed the stock market down for 4 months. Once the stock market reopened, it took another plunge of 20%. However, what happens next is what really matters. The stock market ended up surging more than 80% with a very quick recovery. It took the stock market 8 to 9 months to recover to 80%. Now remember, the stock market first dropped by 30%. It then closed down, reopened, dropped again 20%. So that was a total of a 50% drop. 8 to 9 months later, it increases by 80%. So it makes up for all of its losses and adds a 30% gain on top of its recovery. And then just a few short months later, the stock market increases by a total of 107%. So despite the brutal initial crash, the closure, investors who stuck it through the whole period actually came out ahead, which is a pretty remarkable recovery considering how catastrophic things looked when the market first reopened. It's definitely one of the more notable recoveries in market history, given the severity of the initial shock. World War II was from 1939 to 1945. And the reaction in the stock market to this world war was completely different. The United States didn't engage into this war until 1941. We actually did not see a crash during this time. And I would expect that because we already had some experience in the market with a pattern or something to look back at, that there was less fear in the market and that perhaps this would also be another boost. And so once the United States got involved in 1941, we saw a really quick dip, but overall, the stock market rallied and had an increase of about 50%.
This episode is brought to you by Progressive Insurance. Fiscally responsible, financial geniuses, monetary magicians. These are things people say about drivers who switch their car insurance to Progressive and save hundreds. Visit Progressive.com to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states or situations.
This podcast is supported by MIDI Health. Are you in midlife? Feeling dismissed, unheard, or just plain tired of the old healthcare system? You're not alone. In fact, even today, 75% of women seeking care for menopause and perimenopause issues are left entirely untreated. But it's time for a change. It's time for MIDI. MIDI's not just a healthcare provider. It's a women's telehealth clinic founded and supported by world-class leaders in women's health. Their clinicians provide one-on-one, face-to-face consultations where they truly listen to your unique needs. They offer a full range of holistic, data-driven solutions that isn't one-size-fits-all care. This is care uniquely tailored for you. At MIDI, you will find that their mission is clear: to help all women thrive in midlife, giving them access to the healthcare they deserve. Because they believe midlife isn't the middle at all. It is the beginning of your second act. Ready to feel your best and write your second act script? Visit joinmidi.com today to book your personalized, insurance-covered virtual visit. That's joinmidi.com. MIDI, the care women deserve.
I want to really quickly circle back around to the stock market closing for 4 months during World War I and how we still have a very similar approach, but of course, massively different in order to cool down emotions. The stock market was closed so that we wouldn't see a complete collapse and so people could move through the process, I'm guessing, of the war, as well as their emotions and not going into a complete panic. Obviously, the money was there. It was not stolen from investors. Once the stock market reopened, people were allowed to have access to their portfolios. But you also have to look at it in the sense that the actual closure itself protected a lot of people from selling out of the stock market for those that didn't participate in the 20% drop, in the 30% drop, or perhaps it didn't completely clear out of their portfolios. That 4 months was a cooling period, and then hopefully once the stock market obviously reopened, we saw the 20% drop. But for those that stayed, you got to see a gain. You got to experience a gain in the stock market. We still see that technique applied today. Now the market has what we call circuit breakers. These circuit breakers are built in. They are automatic halts that kick in when the market begins to drop too fast. There are a few different levels of circuit breakers. If the S&P 500 drops about 7% from the previous day's close, trading will halt for 15 minutes. If it drops another 13%, there's another 15-minute halt. And if it hits a 20% decline, the market closes for the rest of the day. The halt isn't only for the stock market in its entirety. It will also be applied, if necessary, to specific stocks. The most recent example of this is with the meme stocks. We saw it during the GameStop saga that took place. I believe AMC was also halted during that entire period where we saw really fast increases or decreases in the stock market. So not only will it be halted on the way down, it'll also be halted on the way up if we're seeing rapid movements. Again, this is to cool down the market and also to protect investors from themselves. I also want to add that a lot of the times it's not necessarily people selling out of their stocks, they themselves. A lot of the times portfolios have what we call stop losses, which means that you can command your portfolio that if one of your investments drops below a certain price, then you can set it to sell off automatically and keep you from losing some of your gains that you have acquired over time. So the halt also stops these triggers from continuing to take place on the way down and sort of have a free fall effect. The halts were introduced after the 1987 Black Monday crash. I should actually call it a circuit breaker. That is the proper terminology. It was introduced then after the stock market dropped 20% in one day. So they wanted to do something similar, but not as drastic as what took place during World War I, trying to stop the panic and ease the triggers from selling out of the entire stock market. We have experienced these circuit breakers be implemented a multitude of times. It was most commonly taking place, which felt like all the time, during the 2020 COVID crash. There were a lot of halts. It felt like for several days. That crash, however, was short-lived. I was so excited to see that crash coming because it was one that I had anticipated and I had been putting money aside to actually buy into it. So every time it would open, I would hurry up and rush to purchase more stocks. We hit the bottom on March 23rd of 2020. And then on April 8th, my birthday, we saw the stock market go into its bull market. What I'm trying to say is that there is always a relatively quick recovery. I hope that these experiences that I've shared with you ease your mind moving forward and keep you from panic selling. Just like I mentioned in previous episodes, I will always communicate what I am seeing in the market. I keep my finger on the pulse. And as you all already know from this podcast, one of my passions is communicating what I am seeing. Switching gears here, I just want to share with you some of the inflation data that we got in last week. It was a relatively heavy week on data overall. We did get preliminary Q4 GDP growth, and it is not looking good, y'all. So GDP, as a reminder, stands for Gross Domestic Product. It is one of the measures we use to identify the growth of the U.S. economy using goods and services. It is also one of the data points used to determine whether or not we are in a recession or a recession is underway. So what I mean by preliminary numbers is that we are 2 months into getting the actual final number. The final number won't be determined for Q4 GDP until next month. So Q4 GDP is the last 3 months of January 2025, and here is how it is looking. The GDP growth came in at 0.7%. This is a concern. The forecast GDP, what analysts were expecting, was 1.4%. And the previous GDP for the last quarter, for Q3, was 4.4%. So when we see continued decline is when we determine that we are in an official recession. Moving on to CPI data, which is the Consumer Price Index. This measures the change in prices paid for goods and services over a period of time. It measures the inflation experienced by us, the consumers. CPI increased in the month of February at 0.3%. This is what analysts were expecting. Year over year, CPI came in at 2.4%. As a reminder, the Fed is looking for a 2% increase year over year. So we are still higher than expected. And then the market is showing some concerns because we are expecting for this data to come in higher with the increase of oil prices, which impacts gas and energy. So stay tuned for that. We could potentially be seeing, of course, higher inflation. Let's take a look at the PCE data that came in last week. PCE stands for Personal Consumption Expenditures. This is also known as consumer spending. This measures the changes in consumer spending behavior of goods and services, such as substituting purchases when prices rise. So let's say, for example, that you buy a specific high-quality name brand of eggs, and then all of a sudden you switch over to a generic brand, then that is what the PCE data is tracking. And believe it or not, the Fed actually places a lot of weight on this data specifically. I would say that it places the most weight on PCE data. So for the month of January, PCE increased by 0.3%. This is in line with what analysts were expecting. However, it is still an increase. And year over year, core PCE was 3.1%. This is also in line with analysts' expectations, and the same rule applies here in that we are looking for a 2% year-over-year increase. So at 3.1%, that is relatively high. And the last time we saw anything close to that number was back in December of 2023. So you can see that things are not improving. We are still dealing with massive inflation. And of course, we have yet to see how the war is going to impact us. Lastly, I want to share that on April 25th and 26th, I will be teaching Wealth Warrior, the course. I have not taught this course since February of 2024. It's been 2 years, and I am excited to bring this back, especially right now during these times. You all know how I feel about investing, specifically becoming a direct shareholder in the market. As I mentioned, the course is going to take place live in a virtual setting on the 25th and the 26th. This is a 10-hour deep dive crash course with, of course, the opportunity to ask me any questions that you may have. And you will then have access to the recording, which you can access for the rest of your life. That gives you the ability to revisit the recording as many times as you feel necessary. Okay, so here's the crazy part about all of this. I have decided to bring back the course for only $98. I have not sold the course at this price since 2020. I sold it at that price in 2020. So 7 years ago is the last time I sold it for $98. And the reason I sold it at that price back then is because I truly did not understand its value. It wasn't until my students began to talk to me about the impact that the course had on them. We've had 3,000 people move through this course. When they would come back and show me their portfolios and talk to me about how their mindset completely changed pertaining to money and how what they learned didn't just impact their portfolios, but it impacted their entire money mindset. They opened businesses. Their lives completely changed. And so as I processed that, I also understood that my time is valuable and the effort and all of my years of experience of investing in the stock market also has value. And it is not that I am undervaluing myself today selling it at $98. It is that we are going through a really challenging time, and I can't deny that. We've seen goods and services increase by 30%. Right now, I do feel like it is an important time to begin your investing journey. I don't know how long I'm going to keep the course selling for $98. I just know that I feel like this is the right thing to do right now at this point in time. I want to make sure that Wealth Warrior, the course, reaches the people that it needs to reach. So if you've already taken the course and you've benefited from what the course has provided for you, then I would like to ask you to share Wealth Warrior, the course, with your friends and family. Let them know that I am doing it at an accessible price. Talk to them about how it has impacted you and your households. I honestly am honored that it has been 7 years and I'm still talking about the stock market and you all are still listening. I just want to make sure that everybody has access to this information. Investing in the stock market is nothing like investing in real estate or anything else. This course is going to be a really important investment, and at $98 for 10 hours plus access to me, I am telling you it is worth it, and you will absolutely see the return in your investment if you put it to work. I am extremely excited to be making the course this accessible, and I hope that we see a new wave of investors come into the stock market in the same way that we saw the wave back in 2020. Now, it's important for me to share that because the course is going to take place live, although virtual, but you will get to see me in real time giving the course, I am limiting the amount of spots that are available. This is because I do answer questions within the course itself. And so if we just opened it to an unlimited amount of people, then it could be something that is not manageable for me. And of course, we have the chat that is open, and typically students will talk to each other, or there will be points of clarification that are being made in the chat. If there is something you didn't quite understand, it will be reiterated in the chat by someone that is moderating. And then, of course, any questions you have at the end will be answered by me. I am just really excited to make this course as accessible as possible. And I am really, truly hoping that this course brings in another wave of investors into the market and is a resource for those that wouldn't otherwise have access to this type of information. Courses like Wealth Warrior, the course, sell for thousands of dollars. And that really makes information like this inaccessible for people who really need it the most. And so, as I mentioned, I'm really hoping that this information finds the right people. So if you've already taken the course or you feel like you don't need it, then maybe there is someone in your life that can benefit. Please share this information to them. I look forward to seeing you all on April 25th and 26th. Thank you for joining us on this episode of Investies Podcast. I'm your host, Linda Garcia. Investies Podcast is a Cosmic Standard production. A shout out to the team, Asia Simpson, Eliza Smith, and Jacob Winnett.